Please hand it up.
This.
I don't know which one is wrong. Mine is wrong.
Time is up. Please bring your quizzes in if they're out there still. There we go.
Then I looked over and I saw you laughing, and I started laughing.
Okay. You remember at the start of this class, I said that the world can shift under you while the class is in motion, right? Many of you did evaluations before last Thursday, right? You valued your company, there's the price of the company, and you turned in your value. Some of you might have felt more secure than others. We did a story, a value, a price. And maybe you felt pretty good on Wednesday. I'm not sure how you feel today, but 2 days can make a difference. Right? We met last Wednesday. After the class ended, I taught my the evening class for the undergraduates. I got on a flight to Santiago. I get on the plane. I'm checking the Yankee score, which is probably the only thing I'm interested in. When a news story hits my phone, and I'm pissed off because I'm watching the Yankee game. It's right in MLB.com. And the news story, of course, was about the tariff announcement. Now, we've been expecting tariffs all year, right? Because, in fact, if you listen to Trump, he's been talking about tariffs for 40 years. So you're saying, what's the surprise? The surprise, I think, was what? That there were tariffs? So what is it about the Wednesday announcement that shook people up so much? Sorry, what? First, it's breadth, right? Everybody gets it. Now, there's the map. You're saying, oh, what happened in North America? That's because Canada and Mexico have already been tariffed, so they're off the table. The big chunk of over Asia is Russia, which at least in theory is under sanctions, so it doesn't need tariffs. It's tariffs across the world. That's the first. Second is, did any of you check the magnitude of the tariffs? These are not 5%, 10%. They're monstrously large for some countries. And the third is the way the tariffs got assessed. Right? What's the basis for the tariffs?
It was not based on reciprocal terms. It was
No,
based
tell
on
me not. No, don't tell me what it was not based on. Tell me what it's based
They were
on.
based on like the trade deficit
That's
divided
it.
by 2, which is
It's
stupid.
on a percentage basis, right? But the divided by 2, fine, but on a percentage basis, which means smaller countries like Vietnam will have a bigger percentage trade deficit than larger countries. So it's broad, it's wide. And the problem with basing it on trade deficits is already some countries have talked about cutting tariffs to zero. You can cut tariffs to zero, but the trade deficit won't go away still, right? So that's almost an unfixable problem. And if this remains the basis for tariffs, there's going to be no easy walking it back, at least without losing face. So it happened Wednesday. Luckily for me, I lost my internet connection once I got in the air, okay? Which is a blessing sometimes. Maybe we should just go on a flight for the next 6 months. Okay? Maybe one of those that spaceship that those guys got trapped in, that's where you want to go for the next 6 months, because clearly things are going to happen. Okay? But on Thursday and Friday, markets melted down. I won't take you through, but I spent the last, I started after I finished your office hours at 6 p.m. I started writing this thing. At midnight, I finally said, I'm exhausted, I'm just going to bed. But this morning, I think I'm pretty close to complete, so I'm going to put it up later today. But I'll give you a preview. Okay? course, we looked at the indices, you can see already. One of the things about teaching a valuation class is I don't have the luxury of engaging in abstractions. This is the real world and I can't get around it. So I want to spend at least the first 10 or 15 minutes just talking about Thursday and Friday. Because you're all affected by it in terms of your valuations and potentially your jobs, right? I scared you already. You say, oh my God, I have a job offer already. But this is, in a sense, earth-shattering, earth-shaking in terms of what it can do. So that's what, but the problem with indices is they're a subset of companies. So during COVID, one of the things I started doing on a weekly basis is downloading the market cap of every stock from S&P Capital IQ and just aggregating. So first thing I aggregated based on is on region. I wanted to see with the pain spread out, and if you look across regions, the worst hit part of the world, in terms, and this surprised me, is what I call small Asia. Don't take that as an insult. It's Asia without India, China, and Japan had the biggest hit on Thursday and Friday. India and China actually look pretty good, but remember their markets closed before the US Friday market. So I haven't looked today because again, I choose not to look while I'm writing the post because it can contaminate what you're writing. But my guess is that the morning in China was probably not a great start. So that might just be a lagged effect. So it's across the globe. You see the percentage drop off. And then I started slicing and dicing the data. And I'm going to stay with the US data for this because I want to look at, hey, where was the damage the greatest? If this were panic selling, when you look at the data, what should you expect to see? What kinds of companies should go down the most? What kinds should go down and which ones should not benefit, go down the least? Where should the money go from? Risky, non-cash yielding companies to save. So basic. And at first sight, when you look across sector, there's some backing for that safety there. If you look at the sector that did the best during this period, during those, so I'm focused on just on this, on the last week, because that's a week of the, you see utilities and consumer staples, which kind of makes sense, right? Staples you need in recessions and good times and bad times. And the worst performing sector was actually in percentage terms. But technology left almost 1 point, if you look at the chain just in the week, technology lost $1.8 trillion in market cap just in the last week. If you slice based on market cap, again, I wanted to see was small companies hurt more large. Here there was almost no difference. Small and large across the board, you saw damage across the board. If you break down companies based on PE ratio, were low PE ratio stocks performing? Well, at least marginally, the lowest PE ratio stocks were down only 8%. Kind of scary to say only 8%. High PE stocks were down about 11%. So there's some mild backing for a risk effect. But then I broke companies down by debt. I looked at debt to EBITDA, broke down by decile. Almost no difference. In fact, lightly levered companies actually did worse than highly levered companies. Maybe that's got the technology overlay on it, trying to drive it. And finally, I wanted to see whether dividend paying stocks were worse affected. There's no difference. This is all leading somewhere because you're looking for clues as to what exactly is happening. So final question I asked was, is this just an with some of the stocks that got bid up the most last year? I broke down stocks based on percentage change last year. So it's like a momentum play. Was it a reversal? Look at the last column, not really. The bottom line is look across stocks. This looks more like an orderly retreat than a complete panic. The complete panic, you're going to see the shifts across. You're not seeing that, at least it's very early in the process, but you're not seeing it there. Question? Yeah.
Bill Ackman was talking about how a lot of this might just be odd shops, institutional investors and funds that are essentially have parameters, and then once they get below those.
It could be, right?
Do you think a lot of it's that, or how do you kind of set
Well,
that up?
that'll happen. If it's happening, it'll happen on a continuous basis, right? Levered investors needing to get out fund flows Your passive investing. Passive investing, remember, is a momentum feeder, right? The upside, it pushes up momentum. On the downside, you're going to extract your money across the board based on market cap, right? So the same things that help you. And that's why I've never built it, bought into the story that somehow passive investing just pushes markets up. It feeds momentum in both directions, and we're seeing it feed in the other direction. So maybe that's what indirectly is driving institutional investing pulling back, is funds leaving they're losing money from their clients, and they got to pull it out of the market.
And then from like our perspective, I have invested into X. Are you still gonna probably sit on that?
We'll talk
Hey,
about
we-
it.
We could go fundamentals and then maybe.
No,
reassess.
because I think no one, and this is why I think it's dangerous to have one recipe for everybody, because I'll talk about the three things that you have to look inward to decide what to do next. I did look at the Mag 7, always in there. And leading into last week, they were already down collectively about 15% this year. Last week, they lost another 10%. So last week was nothing, they were just like the rest of the market, but the leading in there much. But just to give you perspective, that's $1.55 trillion in market cap lost just in the last week by the Mag 7. So that's what the equity markets look like. Damage across the board, very little differentiation across different classes. Now, of course, when you have crises, you sell stocks, if you remember, some of this money that's disappearing is gone forever. It's not coming back. It just disappears in the whiff of air. It's trillions of market. It's not like people extracted 5.5 trillion from these stocks and they're putting them elsewhere. It just disappears into thin air. Some of it is going to turn into cash. That cash has to go somewhere. And usually in a crisis, where does it go? It goes to a place of safety. And for better or worse, US Treasuries still remain that place. And if you look at what happened on Thursday and Friday, you see rates coming down, but again, not by the magnitude expect. T-bill rates actually changed hardly, they were like 0.04%. The other rates, the longer term rates did drop, but by like 0.25, 0.3%. In most crises, the drops you see in the treasury market tend to be much, much larger in the yields. You're not seeing that yet. Yes.
Like since tariffs are gonna impact inflation as well, we may have 3 years of high inflation.
Right now, nobody's talking about even thinking about inflation. That will come, right?
Like, instead of going to the safe haven of 10 years, they might go into money markets, and since that has.
No, where do money markets invest?
3 months. But that's not gonna drive down because it has.
No. What do you mean? If that much money goes to money markets, goes into 3-month T-bills, it will definitely drive down the yield. There's not much money going into the 3-month right now. That could very quickly change if this continues. But right now, you're not seeing the funds flow, which you normally see into a 3-month T-bill. Because you take a look, I'll show you some of the other crises. The T-bill rate just collapses during a crisis because of cash, from all those money market funds in the aggregate. Now push it down. And might push it down below inflation in the near term because that's what panic buying does. Then I looked at 3 very disparate investments. I'm not going to call them assets. Oil, gold, and Bitcoin, right? Oil is my stand-in for commodities. Basically, it's capturing what the investors are thinking about the real economy in the near term. And oil prices are down. In fact, this morning they fell below $60. If any of you valuing oil companies, you better revisit your valuation because last Wednesday this was $78. Now it's $59. Your oil company might have become a distressed company. That money-losing company you have in your group, well, guess what? You just have a money-losing company by accident, right? Gold I picked because it is a collectible of long standing. Whenever you have a crisis, gold held its own last week, but there was no surge. Again, it feeds into, if this is panic selling, you're not seeing it show up in the usual panic assets. And Bitcoin actually surprised me. People present it as a collectible. But for the last 15 years, you know what the track record of Bitcoin has been during crises? October, I'm going to show you the COVID crisis. February 14th through March 23rd, stocks were down 33%. What did Bitcoin do, Michael?
I think it went down even more than that.
57%, down 57%. Stocks came back 45% in the next 9 months. Bitcoin was up 80%. It's like a very risky stock, which is the exact opposite of what you want in a good collectible. For the first crisis in its lifetime, Bitcoin actually held its own on Thursday. And that too can very quickly start to shift. I don't know what the open trade was today, but at least for those 2 days, it was a decent collectible. This might be the epigraph you write on Bitcoin's tombstone, did really well for 2 days in April of 2025, but it did do well on Thursday and Friday, 2025. Okay, so, you can go through it and make your own judgments, but as I look at it, for the moment at least, and it's very early in this game, it looks like there's a lot of selling. It's being driven by people reassessing what they think about equities for good reason. Could it become panic selling? Very quickly, right? Panic sets in, Right now, it hasn't happened yet, but this bears watching. So I'm going to probably regret saying this, but every Friday for the next few weeks, which could stretch into the year, I will revisit the numbers, because the only way to deal with this is to actually let the numbers tell you where you are. So I'm going to revisit all those tables every week for the next, in the case of COVID, I started on February 14th of 2020. I didn't stop till November of 2020. So this is like a sentence in prison, but it's something you have to do during a crisis. So now I'm going to step back, because every time you're in a crisis, you get caught up in what do we do? So let's look at a typical crisis and how it unfolds. I call this my crisis cycle. There's usually a trigger, right? Something that sets the crisis off. The trigger can be, as we saw with the 2008, the Lehman collapse, in 2020, the COVID, but usually that trigger is not completely unexpected. Were there signs that the financial service business was in trouble before Lehman went under? Bear Stearns flirted very close to the edge. They managed to evade that. So that, there are a series of things that can happen, but the trigger is an event. It can be economic, it can be political, it can be financial. And investors react to that event. Now, it's easy to look back with hindsight and say, those crazy investors, they were overreacting, underreacting. You have to react in the moment, right? And I respect what markets do in crises. They try their best. Sometimes they overshoot, sometimes they undershoot, but they don't do what people on CNBC do, which is talk and talk and talk, and nobody ever does anything. They buy or they sell. So I respect that, because it's real action. And what's the only thing you control as an investor? So the news story has come out about the tariffs. What's the only thing you control? Whether you buy or sell, the price, right? And if you're afraid, what happens? You demand a higher price for risk. You sell your stocks until you get to that reasonable return. And you usually take the money and move it to someplace safer. So that's the first reaction. That's day one, day two. But then there are aftershocks. It's like an earthquake. What are the aftershocks? That initial event sets off other events, either in counter to the original event. The case of tariffs, it'll play out either as some countries saying we're going to drop our tariffs. The EU this morning announced that they would be willing to drop their tariffs to 0%. Or you could have what China did, which is we're going to raise our tariffs. So both things can play out. Good news, there was a rumor this morning that the tariffs might be paused. The market jumped up 3%. So you're going to see more and more of that happen over the next few days, because you're an edge. This becomes the basis for the market. Will it play out in the real economy? Of course it will. How can it not, right? That same fear factor that's affecting investors, affecting consumers, businesses. Will it cause a recession? Maybe, maybe not, but there will be an economic slowdown. That economic slowdown has one bonus, which is it'll dampen inflation. So even though there might be a tariff effect, there is this lesser inflation. So there will be a real economic effect. Why do we care as investors? Because it'll affect earnings. And through earnings and cash flows, it'll affect our value. Will there be a long-term effect? Depends on the original events. Sometimes they do, sometimes they don't. If it's a long-term effect, you reset your expectations about real growth and inflation going forward because of the event, which then feeds back again into financial markets. So I'll take you back to 2008. The triggering event was the Lehman collapse on September 13th and 14th, the weekend leading into September 15th. Woke up to September 15th, the market reacted. And over the next few weeks, the market lost, the stock prices dropped by 28%. Again, I'm going to break down the first 2 weeks versus the longer period. The first 2 weeks after the Lehman collapse, stocks dropped 12%. In the subsequent weeks, it dropped another 16%. Treasury rates, starting the process, were 3.72%. By the time this process played out, they were down to 2.2%. No, basic. And that was across the Treasury spectrum. There was and there were aftershocks after Lehman. I mean, I remember weeks when there were rumors that Morgan Stanley would not make it through the end of the week, that Goldman Sachs would not make it through the end of the week. Luckily, those rumors didn't play out, but there was a real economic effect. We entered a recession. The recession was deep and fairly painful. Unemployment hit 10% by 2009. And did the 2008 crisis have long-term real economic implications? It took almost 5 years to get back to pre-crisis levels in terms of earnings and economic activity. And then people wrote a postscript about the 2008 crisis. What did they conclude? That it was banks behaving badly and ratings agencies not doing their job, and that if regulators did a better job, and then we would not have had it. One of the things I'm going to argue is the postscripts that are written after many crises are based on a sample size of 1. And they often deal with the symptoms rather than the causes. But that was the 2008 crisis. September 12th of 2008, I started estimating the implied equity risk premium every day. That's the other thing I do during a crisis, is I start doing this every day, just for my own sanity or insanity. Okay. So there's the implied equity risk premium, start of the crisis. There was a day in November where the implied equity risk premium for the US, in fact, that's exactly why I call this the price of risk. You're afraid, you push up the price of risk, you push on. At the end of the year, the implied equity risk premium for US equities was 6.43%. It did not get back to pre-2008 levels till last year. 16 years to make it back, and now it's back again, back up above 5%. What about 2020? February 14th, we get a news story out of Italy saying they'd found some COVID cases in Italy, and they could not connect those cases to either China or cruise ships, which until then we assumed were the places you had to go to get COVID. That was the delusion we operated under. That, of course, triggered the COVID crisis, and in the next 6 weeks, the S&P 500 lost 33% of its value. Treasury rates are already low coming into the crisis. 1.6% drop to 0.76%, a historic low. Were there aftershocks? Yeah, every week there's stories of health crises, hospitals that couldn't handle it, businesses that were shutting down. And the market kind of played out. Was there a real economic impact? In the quarter that the economy shut down, obviously earnings collapsed that quarter. Unemployment, I think they even stopped reporting the numbers because it became pointless. It was like 30% plus because everybody was collecting unemployment. And it looked like we were in for the long term, but this was almost magical, and perhaps not so magical when you think about the multi-trillion-dollar government support systems that kicked into place. By September, the economy was starting to roll back into place. Unemployment was starting to come down. It didn't fully come down till 2021 and 2022. But this one, the long-term effects didn't seem to persist. And what's a postscript from COVID? Governments and central banks can stop these problems if they step in and act big. Again, as I said, the postscripts often draw the wrong conclusion, but that's a conclusion that people drew out of COVID. And as with 2008, I computed the equity risk premium every day during COVID. Started on February 14th at 4.4%. There's March 23rd of 2020. It hit 7.75%. But the difference here is by September, it was back to pre-crisis levels. It's very early in the game. So as I said, with postmortems, I think the problem is it's like statistics. We have a sample size of 1. Every crisis is a sample size of 1, and we extrapolate lessons we shouldn't. What investors, when you show those graphs to investors, you know what the reaction is? Markets always come back, right? Look, they came back. Therefore, what should you do if you're a contrarian investor with a long time horizon? You should be buying stocks now because look at those graphs. And here's the problem. Just because a catastrophe did not occur during that crisis doesn't mean that the probability of a catastrophe occurring was always zero. 2008, there was a very real chance that we could have gone into a global financial meltdown. It didn't happen, but the fact that it didn't happen doesn't mean that the probability of it not with COVID, there was a very real chance. We shut the global economy down. We could not have, we were not able to start it back up again. That's why we charge an equity risk premium, is we hope and pray that we don't see that catastrophe during our lifetimes. But if you look at the last 300 years of equity returns, somebody sent me this graph. It actually is very close to the T-bond rate. Because you have enough catastrophes in a 300-year period that it eats away that upside you saw. Luckily, none of us will live to be 300 years old. But hopefully we won't see that catastrophe in our lifetime, because if 300 years is what it takes to get back to steady state, if we have that catastrophe, we won't make it back in our lifetime to where we were before the catastrophe. Yeah.
You measure then that risk, that probability of a downturn, the possibility of the Fed bailing you out? Not you, but.
It's, investors probably do, but the question is, if the problem is too big for even, what can the Fed do if real economic growth comes to a standstill, right? There's some, maybe the COVID problem was particularly, susceptible to the Fed being able to fix it, because it was, hey, we'll give you enough money till the economy starts rolling again. I'm not sure in 2008 the Fed could have done much, and it tried, right? It tried, but it didn't work that well. So maybe the Fed can do things in some crises, but not in others. Yes, Julian.
Do you think that like we hit a point where like I'm gonna the White House like rolls back everything, like just shaking too much confidence that like people stay stable?
Investors are very, very resilient. We've learned to be since 2008. I think that what it'll do is create more volatility around what exactly. It's not that the rollback by itself is the issue. It's will there be a roll forward, roll back, roll forward. This is not a game where you say roll back, trust us, we're not coming back to this again. This is something where you're going to see this part of it. Markets will learn to live with it, but it'll take a while. And it'll show up maybe as lower stock prices and higher equity risk premiums in the long term for us to be okay with it. So we're 2 days into this crisis. Today's day 3, right? Thursday, Friday, Monday. So it's a little early to be passing judgment. We're through the first 2 phases. There's the tariff announcement, the first 2 days. There's more to come. Will there be aftershocks? Yeah. Friday you had China countering. Today you've got the opposite, maybe some good news coming out from some countries saying, but this is going to be the way of the world for the next few weeks, even months, right? There will be a real economic impact that's almost undeniable. There'll be a slowing. The probability of a recession when people assess it, has almost doubled since last Wednesday. Will it mean we're going to be in a recession? Not necessarily. The numbers haven't come rolling through yet. But there will be a slowing of the economy. Perhaps inflation will leave center stage. For the last 3 years, since 2022, inflation's been this, hey, I want to be the star, I want to be the star. Maybe this will take the focus off inflation. Maybe that's the only good thing that comes out of this. The long-term impact, let's face it. The global economy has benefited from free trade. Now we can argue that those benefits have been unfairly separated out to different groups. But you make it more difficult to conduct global trade, which I think this process will. Global economic growth will come down. The pie will get smaller, but here's where I think it becomes tricky, because the pie could get smaller, but the apportionment of the pie can change because of this. Now, what I'm hearing from the White House as a defense is not about markets. It's about, hey, we want the pie to be apportioned differently, and for better or worse, that capital has taken too large a slice of the pie over the last 4 decades. And I think that's absolutely true. By capital, I mean equity market shareholders. And that maybe the smaller pie, there will be groups that actually come out better off with the smaller pie than with the larger one. That's what we don't know. And anybody who claims differently, I think, is just barking up a tree. I don't see how you can tell me that it's not going to happen. So it's early in the process, but I'm going to be estimating implied equity risk premiums end of every day for the foreseeable future. So this graph is just very early. This is how the COVID graph started. I was teaching on February 14th and February 21st. I remember putting this graph up saying it's 3 days in. Let's see where this goes. We're 2 days in, and every day I'm going to update this graph. And perhaps by May 6th, the graph will start to take form in a way that hopefully doesn't look like 8% equity risk premiums by the time we get there, because that translates into 25, 30, 35% corrections. But that's so far where we are. T-bond rates have drifted down. Equity risk premiums are now 5.08% Friday close. So I don't know what it'll be by the end of today, but no, it's a table I will keep updating through. And of course, there will be aftershocks, there will be economic effects, real short and long term. And that's still what we're watching. And now, of course, one of the things I would strongly suggest you do is stop watching CNBC. Because I will predict there'll be 3 groups of experts who will show up. So the next time you see an expert, play it like a drinking game, right? Expert, which group do I put it in? The first is with the I told you so group. I told you so. This was going to come to a bad end. I told you so. You're going to hell. So this is, of course, the group that wags its finger and says, this is, oh, you deserve it, you investors. You've been lazy and sloppy and punishment is coming. They're like that guy on Times Square. I don't know whether he's still there, who says, you're going to hell, you're going to hell. He reads from, And they've been saying that. So when you see one of these people show up on CNBC saying, I saw this coming, go back and look at their history to see how long they've been telling you that they've seen this coming. And most of them have been doing this for more than a decade. Then ask yourself a question. If you'd listened to them right from the beginning and you'd gone into cash when they told you this was coming, would you be better off than somebody who actually didn't see it coming, went through the crash and dealt with it, right? So I told you, so they're the most obnoxious group of all. Like, that group will come to the surface right now, the bubblers. The second group is the exact opposite. They're the knee-jerk contrarians. You should buy. Why? Because everything is down. That's the entire argument. Stock prices are down a lot, so it must be a buy. And the third group is this hand-wringing group, or there's uncertainty. On the one side, the other hand, the third hand, the fourth hand. This is the market strategist group. They will get on there, and by the time they're done 5 minutes later, you don't know whether they told you the markets are going to go up, down, or just stay where they were. But if you listen to them, you should just sit on your hands till the uncertainty passes, and then you can do neat stuff. Because you could be waiting forever to do this. So here's, and this goes back to the earlier question, what should I do today? I'm going to tell you what I would do, but I want you to look inward at these 3 things because they'll determine what you should do. First, if you need cash in the near term, don't be waiting. In fact, leave the class right now, go sell your stock, convert to cash, because the most dangerous thing you can do is if you need cash 2 or 3 months from now, is wait for a better time. Who knows what 2 months from now will bring? So cash needs and time horizon are bundled up. So if you don't need cash, you have the luxury of waiting, but you might choose not to, right? But at least you have the luxury of waiting. Second, your macro views have to come in, and don't hide behind, I'm not a macroeconomist, I don't know what's coming. This is nothing to do with economics, it's game theory, right? Basically, you've got to have one move, you're going to have counter moves. I think a really good poker player is probably in a better position to forecast what's coming than a macroeconomist. Because there are 3 ways this can play out. It can be a full-blown trade war, in which case, God help us. It can be a partial trade war with some countries where other countries kind of settle in. Or third, it can be this, it'll go away, clearing of the air, the tariffs go back onto the back burner, there's a pause. I think the second scenario is the most likely one from my perspective, but I think the first and the third still remain on the table. And finally, it should depend on your investment philosophy, which is basically what you think about markets, where you think they make mistakes, and what your personal makeup is. I mean, I teach a class in investment philosophy, which I've never taught at Stern, but there's a online version you can see where I say, look, the right philosophy for you is the one that best fits you. So what works for you might not work for me. So here's what I plan to do. I plan to compute the ERP every day for as long as needed. Hopefully not that long, but it's out of my hands. Second, I have 37 companies in my portfolio. I've got to go back and revalue all of them, right? Because this can change their value. Perhaps in good ways for some companies, bad in others. And maybe I might have to prune some of those companies, not because the price has gone down, but because the value's gone down even more. I was comfortable with the companies in my portfolio on Wednesday before this hit. Comfortable in the sense that they were still undervalued and not overvalued enough for me to pull the trigger. That might have changed. Third, and this is going to be a tough one, I can't stop investing just because it's a crisis. Some of you value companies that you think aren't great companies, but they're not great investments. What separates them? The price, right? 3 weeks ago when I wrote about globalization and Tesla, I talked about the fact that I was selling Tesla because of a bunch of reasons. I'd sold Tesla already. But I said I wanted BYD in my portfolio, and I valued BYD, and I said on the ADR, the price was too high for me to buy BYD. I did on that day put in a limit buy for BYD at $5 below my value. I didn't think there was even the slightest chance it would get made, but hey, no harm, just putting it out there. It's a limit buy, it's good till canceled. And last week when I valued Mercado Libre, I was extraordinarily impressed by the company. I initially thought it was like Amazon, but the closer you look at it, this is more than an Amazon. It's got all of the features of Amazon in the retail space. And with Mercado Pago, they've got a full-fledged, I thought initially a payment processing system, but it looks like a bank and a mutual fund on the other side. I valued it at 1,600, it was trading at 2,200. I wish it were cheaper. And I did put the limit buy at 1,500 on Wednesday before I left. On Friday, I checked the price, it's down to 1,800. 2 Fridays is all I need, like last Friday, and it becomes a buy. So the reason I put limit buys is if you have to make the buy decision, you will not do it. It's terrifying actually buying shares. You get to that last stage in the trade and say, are you sure? And you will leave the screen and go to another screen and hope the screen freezes before you have to come back so you don't have to hit the buy. I want to take that decision out of my hands. So if you have great companies, I've heard people complain about not owning the Mag 7. This is your chance. You don't have to buy it at today's price, but value each of them. Amazon might be cheap now, and this might be your chance to buy. So danger plus opportunity, and I think that in many ways it's tough to do, and finally, I don't plan to let this take over my life. So I'm going to go back to San Diego on Thursday. My daughter's having a baby shower on Saturday. I intend to fully enjoy the baby shower. And my granddaughter has a birthday on Sunday. That's going to be priority one. I'll take the dog for a walk. I won't even look at markets on Thursday, Friday, Saturday, and Sunday. Monday, I'll have no choice because I have to teach the class again. But I will do the implied equity risk at the end of every day, even on Thursday and Friday. But I think that if you put your life on hold because markets are chaotic, if this is your life, you have to trade, you have no choice, but the essence of investing is you got to pass the sleep test. You know what? I've been sleeping well. I slept Wednesday night, Thursday night, even on a Wednesday night I was on a plane, but I still slept. Thursday night, Friday night. So so far I haven't lost any sleep. I've lost some money on my portfolio, but I've not lost sleep, and that's a win for me. So whatever you do, you got to pass the sleep test after you're done. So that's your test. That'll be a test. If you do something and you're lying awake at night and saying, I wonder what my portfolio will do tomorrow, you fail the sleep test. It's actually a great way to make sure that it's, so do what you have to do. Yep.
What would have to happen in the market for you to lose sleep?
What would have to happen? And if it's happened, the losing faith would be irrelevant at that point, right? If it completely collapses and there's nothing that will make me come back from it, right? So I think the events that will cause you to completely lose faith are the events where it's hard to be your hands anyway. So what's the point of worrying about it? Yes.
With the recent crash in the market and tariffs, like what exactly are you like?
Is it
most-
10% sufficient to call it a crash?
I was mostly trying to say, what variables are you trying to readjust your models, like the growth rates? Is it
What are the only
fit-
variables that control value? Right, let's step back, right? And that's actually a good exercise. How do all these events show up in your value? Through revenue growth, margins, reinvestment, and risk. That's the advantage of having parsimonious models, is it gives you focus. Everything that's happening out there has to show up in one or more of those. Okay? So play it through your company, right? How will a tariff war affect my revenue growth, my margins, my reinvestment, and my risk? For some of you, the effect is going to be dramatic. Take Boeing, right? At least 3 of you are valuing Boeing. This could be a major shift because if you're Boeing and you derive the bulk of your revenues from outside the US, God only knows where you get the parts for your aircraft, you're incredibly exposed. Your craft foods, maybe you're not as exposed, right? Even though you're a global company. So I think the effects are going to be disparate by the time you play them out, but that's assuming we know how the end game is going to be for tariffs themselves. But always kind of bring it back to those basics, because otherwise it's so easy to be reactive and distracted. So I left you with perhaps it's good time because we're talking about, is the market overpriced, right? And we were looking at PE ratios. And I said, look, it depends on the alternative. Here's what I'm going to do, try to address that question. And maybe we can put today's numbers in to see if we can answer the question. I took the price earnings ratio and I inverted it. You know the advantage of inverting the price earnings ratio is? Remember, the price earnings ratio cannot be calculated. When earnings are negative, the earnings to price ratio works even when earnings are negative. You get a negative number, but it actually makes sense. It's a much more robust multiple than P ratio. It's called earnings yield. So there's the earnings to price ratio. That's the red line. The green line is the 10-year T-bond rate. Let me just pause with that. Do those two look like they move together? For the most part. You're saying, what's this purple line? It's the difference between the 10-year bond rate and the 3-month T-bill rate. What am I measuring with that?
Yield inversion?
The slope of the yield curve, right? If that number is a big positive number, I have an upward sloping yield curve. If that number is 0, I have a flat yield curve. If that number is negative, I have a downward sloping yield curve. You're saying, who cares? We'll talk about why that might affect PE ratio. So I'm looking at the level of rates and the slope of the yield curve. See, the first thing I did was what every statistics class teaches you to do, is to calculate the correlations. Correlation between earnings yield and T-bond rate is 0.69. What does that tell me? Higher T-bond rates translate into higher earnings to price ratios. I know it's tough to do, but invert in your mind. A high earnings to price ratio means low PE ratio. So T-bond rates rise, PE ratios decrease. Makes sense. And at least in terms of the sign, the more upward sloping the yield curve, the lower the earnings to price ratio, which means a higher P ratio. So why is an upward sloping yield curve better for stocks? Who cares what the yield curve looks like? Yeah.
Because organize that downward slope in the economy.
In other words, historically, the slope of the yield curve has become a stand-in for what the economy will do in the future. Notice how people flip out when the yield curve becomes downward sloping. CNBC, all they can talk about is a recession is coming, because you got a downward sloping yield curve. It's predicted 16 of the last 3 recessions. Because you took it down, oh my God, the recession is coming. For the last 3 years, the yield curve has been mostly downward sloping. finally the recession is here. I'm sure this will be put into recession predictor. It was worked all the time, right? And this is the problem with predictors. You give yourself enough time, everything is a predictor. But notice the correlation is much weaker. So the level of the interest rates clearly matters, the slope of the yield curve. But I wanted to use this to actually look at stocks today and say, are stocks today correctly priced? So here's what I did. I ran a regression of earnings to price ratios for US stocks. So this is called a time series regression. Basically, I'm looking across time against the T-bond rate and the difference in the T-bond rate and the T-bill rate. Let's read through the coefficients. What does the intercept tell you? Not much. It just says that's my starting point. 3.41% is my base number for earnings to price. Every 1% increase in the T-bond rate increases the earnings to price ratio by 0.56%. Remember again, increasing the earnings price ratio means the price earnings ratio decreases. I now have given you a way of quantifying the effect of what you think will happen to T-bond rates next year. If you think T-bond rates will drop by 1% over the next year, that's going to translate into a drop in the earnings to price ratio of 0.56%, which will translate into a higher PE ratio. Every 1% increase in the slope of the yield curve reduces the earnings to price ratio by 0.116%. But here's a cautionary note. What's this in brackets below the numbers? That's my T statistic, right? What does a 0.08 T statistic tell you? It really is not if I should really rerun the regression and take out the slope of the yield curve. I've left it in there for a reason. But the truth is, if I'm making forecasts, it's more noise than an advantage to have it in there. It doesn't seem to have any explanatory power anymore. Saying, what do you mean anymore? It used to have explanatory power. In 2008, if you look at the T statistic on that coefficient, it was 1.46. In 2001, it was 2.53. Through this century, that number has become less and less significant. And you know what this also means, right? When you use the slope of the yield curve to predict the economy, you're basing it on a 20th century phenomenon where it seemed to do. So what do you think's changed? Why has the slope of the yield curve become a worse predictor of what equities will do than it used to be 25, 30, 50 years ago? What is the slope? How does the yield curve become downward sloping? What is the phenomenon that usually causes it to happen? It's usually not long-term rates collapsing, it's short-term rates rising very quickly, right? And historically, what's caused short-term rates rise very quickly? A central bank hitting the brakes. Paul Volcker in 1979, pushing up short-term rates to 14, 15, 16%. You know what that yield curve coefficient measures? It measures how much central banks affect equity price. And here's the strange irony. 30 years ago, people didn't talk much about central banks. You didn't even know, probably a few people would have known who the head of the head led the Fed. You couldn't name a single other person on the board, right? They were not visible, they didn't talk. And central banks are actually more influential. Now they're all over the place. All people talk about is Jerome Powell. What's he going to do today? I think he had 11:30 a.m. and everybody's waiting bated breath. Jerome's going to save the world again. Maybe he's come out in a Superman outfit and say, I'm going to save the world. The more central banks become visible and central, the less effect they seem to have on markets. Now let that kind of bounce around your head. Maybe the best central bankers are like, what they used to say for children. You probably pulled up for child abuse when you did that. What did they say about children? They should be seen and not heard, right? You can't get away with that anymore. Central bankers should be neither seen nor heard. They should be like invisible people, right? Because they seem to have more influence when they're there and you don't even know what they're doing, but you just see the effects of their actions. So maybe we're letting central bankers kind of get in the way of their own story. If you get a chance, what I'd like you to do is take the T-bond rate right now. I think today it dropped below 4% for the first time in a long time. Take the T-bill rate right now, plug it into that regression. So use this regression out there. See what you get as a predicted earnings to price ratio. See, what am I going to do with that? Let's say the earnings to price ratio you come up with is 4.4%. How do I use that? You invert it and you come up with a PE ratio. You look at the actual PE ratio, and for better or worse, you're getting at least at a point in time, is the market cheap or expensive given its own history and given what interest rates look like today? It's actually very useful in the periods where rates drop to explain why price earnings ratio should be higher when the T-bond rate was 2%. So the Schiller PE, the panic that the Schiller PE created, especially in 2016, 17, 18. All you had to do is plug in the interest rates, and much of that overpricing you saw by just looking at the PE ratio kind of dissipated. So try it out, see what you find, because next session we're going to start on PEG ratios and we'll keep moving. I'll see you soon. Take care. Oh, on the quizzes, I will let you know when they're graded and you can come pick them up. So sometime, hopefully tomorrow.
So giving the MCS presentation tomorrow, so I think I should say this. It's everything because spreadsheets don't look, take nowadays they want to start update it's like all you have to do is update latex, update the key on and second section, what stuff you say was like the Amazon that you were looking at.